Hello, everyone. Good afternoon, and thank you for joining us today for this session where we are going to introduce you to the work of the Dynamic Coalition on Digital Financial Inclusion. And just by way of background, so you know what this initiative is, in May of this year, we had chartered a working group, an intersessional working group of the United Nations Internet Governance Forum, where we have a mandate to explore open interoperable payment protocols and what this could mean for the future of the internet for 2030 and beyond. And to help me unpack all of this, I have several panelists to my left. We have Caroline Sinders, Jeremiah Lee, and Shmriti Pashira. So thank you all for joining us. All three are members of the Dynamic Coalition. And if it looks like we are a bunch of Interledger insiders at the moment, of course it is true. We do have some knowledge ourselves of what the Interledger protocol is, but our broader mandate is to take that message to another community, to the community of the Internet Governance Forum. But before we can do that effectively, we need to, amongst ourselves, have some alignment and agreement on what those messages are that we want to be sharing elsewhere. So to kick us off, I'm going to put the first question to Caroline, if you don't mind, which is essentially, what progress has the Dynamic Coalition on Digital Financial Inclusion made so far? We are new. We've only been meeting for around 3 months now. Nonetheless, where are we at?
Yes, thank you so much for that. I think we've made quite a bit of progress, but one of the sort of more important areas I think we've been focusing on is really taking a concerted effort to think about what is this sort of substantial definition of digital financial inclusion. And I want to read from a few different quotes that members have provided. I think our time on creating this definition really speaks to the care of the coalition as well as our diversity in terms of how we're creating this nuanced definition. So one member describes digital financial inclusion as, quote, financial inclusion must be deeply associated with financial empowerment. Otherwise, it becomes merely a tool for connecting people to hegemonic financial services, when our true goal is to connect them to opportunities. One category of financial empowerment is giving people access to their own financial institutions. I mean, literally transforming the ownership structure of financial providers from mega banks to credit unions, cooperatives, mutual savings initiatives or institutions, and community-based organizations. This can be designed at the neighborhood, township, or community level, and structured in a federated way as seen in Switzerland or Germany, or through credit unions where people from similar walks of life come together to share resources. Another member also brought up privacy being key to this definition. Quote, for me, financial inclusion means that people can participate in financial systems without having to sacrifice their own personal privacy. Privacy commissioners have not adequately addressed the myriad of payment systems, end quote. But this also doesn't cover the sort of extent of the conversations we've had with what are the different barriers to even traditional banking? What are some of the barriers that the current underserved communities are facing in terms of banking? And how can we also have this definition take that into account, especially as we think about some of the predatory nature of traditional banks, a loss of trust that a fair amount of marginalized and vulnerable communities face with traditional banking, et cetera. And then lastly, I just want to share one more quote. While this isn't directly related to digital financial inclusion, but one of our members raised this in terms of interoperability and this notion of how moving money has so many social ties to it. It might be technically easy as sending an email, but it's not as socially easy. And I really, really love this quote. Interoperability is crucial and common standards are necessary to make it happen. However, there's a conceptual issue that needs clarification. The Interledger slogan, simple, email as simple, is elegant, but not a perfect analogy. Well, email represents the transmission of data. Money is far more than a mere data point or registry on a blockchain. Money is a social relationship. It's not a natural phenomenon, it's a social construct built by society, configured through a hierarchical structure that includes the double entry point accounting system of assets, liabilities, debts, and credit. When you transfer money, you're not simply moving data, you're transferring a series of complex relationships. And I thought that was just also really beautiful thinking about, again, this sort of care and nuance that we're bringing to the coalition.
Absolutely. Thank you for that, Caroline. And just by way of background, in terms of the modalities of participation for the Dynamic Coalition, I said before, rather flippantly, that at the moment it looks like we're a bunch of Interledger insiders. However, we are actually bringing in outside experts on all of our calls. We are meeting twice a month virtually at this point in time. We'll also have a face-to-face meeting later in this year as well. But we are consulting with outside experts, and the goal ultimately is to produce a piece of research that is evidence-informed and sound. And so I want to be very clear about that. And the interviews, the expert interviews that Caroline was just quoting from, are part of those discussions that we've had and the insights that we've been able to draw together so far. I'm going to put the next question to you, Smriti, which is, how does your work in India align with the goals of the Dynamic Coalition, and why do you believe that this coalition is important for global digital financial inclusion?
Thank you. Thank you for having me in this conversation and in the coalition. I'm going to start by congratulating Aidan on all the excellent work he's done in terms of putting together the coalition, organizing the meeting, getting this conversation going. It's been fantastic. To get to your question, I think I'm seeing this coalition and at least the work that's happening right now. Is there an echo as I speak? Is it okay? Okay. Okay. I feel that the important thing in the conversation, the way it's being framed right now, is this, the shared understanding and the shared vocabulary that we are developing around questions of what does it mean to be financially included or excluded. And I think it's particularly important given the two sessions that we saw on the stage before this, the idea of very often when people think about technology or regulation, people are thinking about this being a one-way transmission of knowledge, very often from the West into the developing world. But clearly in financial inclusion, that's not the case, because the development, a lot of the innovation is happening in the Kenyas, in the Indias, in the Bangladeshs of the world. So in that sense, this common vocabulary, developing a shared understanding is critical to what we are doing, and I think it's the contribution of the Dynamic Coalition. To answer how it connects with my work, I think part of it is linked to my work with the foundation itself, my project, which is about understanding, what are the metrics of understanding what leads to inclusion or exclusion in particular contexts. And I think there are a couple of ways to look at it. One is, of course, on the supply side, questions of, availability of networks, availability of digital infrastructures. On the demand side, it's questions about digital literacy, skills, trust in the ecosystem. And then, of course, there is the regulatory angle that we've been hearing from the parliamentarians about how do we bring all of this together within a regime that, inspires trust. There's consumer protection, there is, checking fraud. So I think those are the kind of lessons that the Dynamic Coalition can enable sharing. And finally, a lot of my work, and this may not be the most popular opinion in this community because it's full of technologists, is a little bit of humility around what technology can and cannot achieve, and that intersection between what happens when technology hits the realities of society and the structural barriers there. And I think that's, again, where we need to be thinking in the medium term with the Dynamic Coalition.
Thank you so much. And just to flag that we want to keep this session as participatory as possible. So in a few moments' time, we will invite questions from the floor. If you would like to challenge anything that we're saying, challenge from the definitions that we've shared, bring in additional insights, and we will certainly take your feedback back to the Dynamic Coalition. But we also welcome your questions to us as well about digital financial inclusion. Now, Jeremiah, you have, I would argue, more technical expertise than anyone else on this stage. So I think you might be best placed to answer this question, which is, how can interoperability, whether it is between financial institutions, whether it is between other platforms, whether it's between governments, how is interoperability able to help address the issue of digital financial exclusion?
All right, so I might be a little more technical than the people on the panel, but I want to start by talking about the last part, which is the financial exclusion part, because software is not going to be able to fix people problems. It's not going to be able to fix policy problems, and it's not going to be able to fix prioritization problems. So when I think about the exclusion, I really have to start thinking about the types of exclusion. There's intentional exclusion, unintentional exclusion, and I would say accepted exclusion. So that unintentional exclusion, intentional exclusion, that could be a prejudice, but very often in a banking system, it's basically going to be like a market a motive there. Like people in power just choose to exclude. There could also be unintentional exclusion, and this could be the type of exclusion that's an oversight. So maybe it's not having the capacity to be inclusive, or not knowing that there could be other opportunities. And the last part would be the accepted exclusion. And this is where people are very well aware that there is exclusion happening, but the people in charge are not prioritizing that, and everyone else does not have the agency to actually create a change of some kind. Which this, looking at those people things can bring me back to the technology part of the question, which is technology can't fix those particular problems, but what software interoperability can do is basically create the space for innovation to occur. And give a little bit of a longer answer there. I think interoperability, it's the final stage of commoditization in software. So most innovation, it starts out as proprietary, and then you have a group of companies that are providing that service and it becomes a market. And then the last stage of that is commoditization, where it just becomes an accepted norm, an expectation of what someone is offering. So a technology standard is just a bunch of people coming together and saying that this specific kind of value in the market, we are going to deliver it in this specific way. And that standard is what enables interoperability.
Digital financial inclusion is intertwined with so many UN sustainable goals. So we see a key component, we see this as like, I would argue, like key components of our working group. This includes thinking about eradicating poverty, which is sustainable goal number 1, ending hunger, number 2, promoting gender equality, sustainable goal number 5, fostering economic growth, among others. We also sort of see how financial inclusion plays this implicit role in sustainable goal number 17 by enhancing savings mobilization for investment and consumption, right, which can then drive economic growth. But I would also want to talk about how, as with digital financial inclusion, one of the focuses we, again, come back to are marginalized and vulnerable groups. That includes those facing poverty or financial hardship, women and marginalized demographics and groups, also including emergent entrepreneurs and those seeking to be banked. And again, these as groups, as demographics, come up time and time again in our conversations around how do we center that and make that really the focus of when we're brainstorming, when we're ideating, and when we're coming up with all different kinds of solutions. But also more importantly, we also talk about the human and digital right of privacy. And that also is very much in tandem with our conversations. As one of our members said in an interview, there's no reason for transmission streams themselves to not be anonymous, but they bring up this point that at some point financial inclusion requires identity verification. Without managing identity, you open the door to fraud and crime. Therefore, the front end of systems must involve proper identification, but there also needs to be a fundamental respect for privacy, ideally through human rights impact assessments. And again, from like my previous answer, this is something that we actually, one of our members is very much a privacy expert. I would argue all of us have that background, but we are very lucky to have someone like Stephanie Perrin, who I think of as a paramount privacy expert. And again, this is coming up time and time again. How do we center this digital right of privacy to protect individuals as well? Other members have brought up issues like predatory banking, including overdraft fees. How do you move money during times of political unrest when maybe centralized banks or traditional banks do not want money moved, especially out of certain countries or regions? And all these different kinds of frictions that are placed on individuals in times of very specific and poignant need. But also to elucidate this more, I think there's this really great quote also from one of our members that also just talks about even the difficulties and frictions in one's daily life. Who are the ideal consumers that these systems are designed for? It's often not the communities we're talking about. So quote, "The complexity of financial systems raises a critical question. If experts struggle to fully understand them, how can the average person, particularly those that are poor or under-resourced, navigate them? If you're living in poverty, you don't have the time or bandwidth to figure out which system is best for you. There's a clear lack of communication from governments to their citizens and a lack of information at the ground level. People are being pushed to adopt digital financial systems without sufficient public education, and historically there's been little reason to trust these systems. Another concern is technology. Do you need the latest Apple iPhone to use the mobile payments? What if you live in an area with poor bandwidth or only have access to a flip phone? And what about children? They need to spend money too. Are we going to trust them to manage a digital wallet? I have grandchildren and they don't get smartphones until they're 12. If they need a phone for safety, they get a flip phone. They still use coins to buy things, which is common for kids who spend money. They need to buy food and small items regularly, but are they fully prepared for a fully digital system? End quote.
Thanks. And one of the reasons why we've been trying to link our work so much to the Sustainable Development Goals is, aside from the fact that they are relatively uncontentious and they are ideals that we can all get around, and because achieving digital financial inclusion would support the achievement of 8 or is it 9 of the Sustainable Development Goals, is also because we do not want the work of the Dynamic Coalition to just consist of a report on a shelf that is not read and not acted upon. So we are hopeful that by trying to show that addressing this challenge can result in material change across different elements of society, we can have impact as a working group. So I'll put the next question to you, Shmriti, which is, what are your hopes for the future? What do you hope that the Dynamic Coalition will be able to achieve in the next few years? What impact do you hope it will have? And what role do you see diverse voices and diverse stakeholders having in that future?
Yeah, thanks for that. I think it's really critical, as you said, we're at the early days of the Dynamic Coalition, and of course, by design, we have started small, but in the next 4 to 5 years, where I hope we will end up going is, closer to the IGF's own agenda, the history of the IGF. It started as an initiative to be more and more multi-stakeholder, and that we need to get there, and that means we want a cross-section of stakeholders. We want more technologists in the room, we want more user group, consumer groups, we want parliamentarians in the room, so policymakers. And within those groups, I think it's important to say, to go back to the earlier point that I was making, we need regional diversity within those groups, right? Within parliamentarians, you want someone from the developing world, you want someone from the developed world. Within technologists, you want someone from Google Pay, but you also want that struggling startup person who's, just about trying to launch a new idea. So, and it's not going to be easy to get all of these voices into one dynamic coalition, obviously. And I just wanted to share some experience from some of the other dynamic coalitions that, I have been associated in the past. There's one on net neutrality, there's one on data governance and AI, and one of the things that they have been doing, and a lot of this work is hosted out of FGV University in Brazil, where I've been associated, is to kind of do this annual call for papers, right? So there's one model that we are doing, but in parallel it could be that, you have a call for papers and you open it out to the public, where anyone from any region can participate, and then at the IGF you convene and discuss these. And over 4 to 5 years, this kind of becomes like a time series of useful information where in December or November every year, this is how we progress. These were the case studies, these were the good examples and the bad examples. And I think that could be one way to kind of make this more multi-stakeholder and more intra-regional over time.
Thank you. And we also welcome your thoughts on the question of diversity as well and what diversity looks like. Sometimes we use geography as a rough proxy for diversity, population diversity in general. And in a small working group, I think that can seem logical to seek out participation from different geographies, but diversity is often intersectional as well. And so maybe it is not necessarily as inclusive or as broad as it should be. So we welcome your input there in a few moments when we do open up for questions. Before I do, Jeremiah, difficult question, but we do have a few lawmakers in the room, so I'm going to put it to you, which is, how do you think that governments and regulatory bodies can create a more conducive environment for digital financial inclusion?
There's a number of things they could do. So I would say, first of all, you should go watch Smriti's talk from earlier today, watch the recording, because she gives a really great example of what's happening in India with the UPI system. We can also look at what several different countries and regions are basically following quite a similar pattern. In the EU, we have something called PSD2. The US has a number of different pieces of legislation that are moving in this direction. But yeah, there's a number of key things that I could say, like, if you could make this happen in your country, you're going to set up digital payments for success. The first is that you need to mandate participation. Most of the financial systems are they are the way they are for a reason. There is a market and a financial incentive to not introduce more change in them than necessary. So as regulators, you have to introduce that change. So I would start with like a mandate that every bank start offering its customers, I'm going to say, free bank-to-bank payments within your jurisdiction. We have a great example of India doing this with UPI that I just learned this morning, has a zero merchant discount rate. The EU is doing something similar where they're strongly advocating for no-fee transactions up to a certain limit. But you also have to have the pieces of infrastructure in place to do that. And the key thing there is basically a central bank operating a central clearinghouse where every bank is participating and they can actually clear those payments in real time. And it sounds like a big expensive investment, and it is. But the cost of doing that is going to be less than the GDP increase that you're going to see from having more money actually move inside of your economy. And you're also moving so much of that economy into the light. It's no longer a shadow economy that happens with cash. That introduces the possibility for effectively enforcing your taxation laws. And I think last year at the summit, we saw a really great case study from Jordan on how they actually did that transition over a decade. Another key thing here to introduce competition is increasing the number of financial service provider types, other than just having the one big, giant, really hard and expensive to get banking license. So at a minimum, it's really about having at least electronic money institutions and authorized payment institutions. They have a smaller scope of responsibility, so they don't have to be as heavily regulated. And they still have regulations, of course, but that means that their barrier to get into the market is much less. And you're also diversifying the types of players that can then participate in that market. And all of these are relying on a few other pieces of infrastructure to exist. The first is some kind of digital ID, which you talked about earlier. Preferably it's a digital and decentralized identification system. And this is so that people can prove that they are really themselves. And this is important for inhibiting fraud and criminal activity using digital payments. But it's really about digital attestation that I'm making this payment and it's really me who's making this payment. And that might sound like, okay, now I actually have more visibility on who's making the payment, but it also creates the regulatory option to actually increase the amount of privacy that can be provided in digital payments. If you have this sort of system in place, it allows you to introduce a privacy control where the sender can actually, the payer can retain anonymity because there's full transparency about who's receiving that money. I actually think that would be a great leap forward over existing payment methods, digital payment methods that we have in the world, like the credit card networks. You need broadband internet access, continue those investments. You can't participate in digital payments without those things. And the biggest piece is really the education and the advocacy component. People are not going to just immediately switch over from cash to a digital payment. They're going to have to build trust with that system in addition to learning to use it. And I think we just saw an example. We were discussing this in the Interledger Slack recently. In the Philippines, the Gcash mobile payment app has become wildly successful. And they have seen a correlation in the increase of gambling addictions happen that parallels this increase in adoption of digital payments. So these are some people who are getting access to their own money for the first time. There's an element of digital literacy that has to accompany that increased accessibility. So they know how to use these things responsibly and don't get into trouble with them. And I'd also say, there's a lot of things about the Gcash app, but I would also say, perhaps don't put mobile gambling in your payment app if you're, as a regulator, maybe don't allow that. So.
Yeah, well, thank you for that, Jeremiah. We do have time to take a few questions now from the audience if you have any questions or comments. And to kick off, it could also be responding to some of the comments that Jeremiah just made there. Also, we would love to hear what you think about what business model innovation is required in order to create an enabling environment for technologies that may displace perhaps those products offered by legacy financial institutions, or just, displace is not necessarily the situation. Of course, solutions can coexist. Are there any questions or comments from the audience on that? I will bring a microphone over.
Yes, tell us about your thoughts for incentives.
The question I had actually was just a response to what Jeremiah was speaking about. Yeah, you mentioned the potential positive effects of mandating involvement in digital payments, but how do you think that could be achieved in a climate where people might be reluctant to participate? The local minibus taxi industry in South Africa has had several attempts to modernize their payment systems using smart cards, and it was rejected by drivers in particular, who did not want to be part of the formalized economy for financial reasons, such as taxation. So how do you get around that sort of negative?
Well, there are a number of things. Actually, could you share what you talked about in India and the required use of it, I think is...
Sure. Yeah, I think there are kind of two sides to it, right? One is how do you suddenly build scale, and very often the governments think that, the way to do it is incentivize or mandate. And one way to mandate that's happened in India is to push towards a zero MDR regime. So unlike credit cards where, you have a 1% to 3% fees that it's paid, in the UPI system, which is the Unified Payment Interface, it's the real-time digital payment system, the government has mandated that there will be zero cost to the merchant of getting onto the system and onboarding them. And now that again has its pros and cons, right? It of course brings a lot of people online immediately, but it is unsustainable in the medium to long run, because eventually if you want a system to work, there have to be incentives in it for people to maintain the technology, to tackle fraud. And if you're not getting the banks to earn, then in the medium term they will lose interest. So there is this tension there, and I see why we would see it's the mandate, the idea of paternalism in some way, saying it's for your good and therefore you should come onto the ecosystem. But I guess there are those risks which come with it, especially in regimes which have a tendency to be coercive, or where the rule of law is not as effective as maybe in other parts of the world.
Yeah, and I would also add on, there are a lot of incentives for digital payments that even the merchants are going to have. Cash is a risk to carry. If you are one of those drivers, you are probably also concerned about being robbed or some other activity being taken against you in the transport of that.
Thank you.
Yeah.
I had a follow-up as well.
Thank you very much for that. My question is on your definition of digital financial inclusion. As you're doing your research, have you developed indicators that would assist for you to pick all aspects of what inclusion might mean? I'm a human rights practitioner, and I would want to see inclusion from the point of view of informed choice, for instance, having that choice, minimization of exploitation, access to gadgets, access to bandwidth, all of those. So it's not so much inclusion of the different providers as it is inclusion of everyone, because an economy that locks out some, in my view, cannot be celebrated, particularly in the context of the UN SDG rules. So do we have indicators so that you're able to tell us, we think so many people are locked out because of ABCD. If you come to Kenya, we think this region is locked out because of this. I don't know whether you're doing that.
Thank you for the question, Senator Muma. And the short answer is no. We're not developing indicators. Now, that could be one of the recommendations that we put forward. So ultimately, how we envision the work of this working group is that we will not be able to tackle all of these issues alone. However, we will be putting together a set of recommendations tailored to different stakeholders, whether they are governments, whether they are civil society organizations, philanthropy, industry. And so I think it is important to have indicators, and I think they should be developed independently. And so my view is that we should have that call, and we will take that forward. However, I don't think we as a working group should be responsible for developing those indicators. There are indicators for measuring financial inclusion that the World Bank has, for example. So there are other metrics that we can explore already to see, to some extent, who is or is not included. Taking that a step further to focus on developing metrics for digital financial inclusion, which differs from financial inclusion, is something that I think would be very important. I'm not sure if there's any further comments on the panel.
Mainly just to say that we do have a diversity of participants, but also from areas of expertise. So for example, I'm a digital rights researcher, and I've spent over the past decade focusing on online gender-based violence and tech-facilitated violence. So one of, let's say, the sort of areas I bring to this, especially in conversations with Aiden, is often thinking about, for example, domestic violence victims and what their experience banking is like. What kinds of coercive control exists in terms of having a shared bank account? How can we sort of bring that experience to, even in a small way, as we sort of expand this definition of digital financial inclusion and thinking about, let's say, the potential benefits of interoperability in blockchain? There is, I would say, a fair amount of benefits of thinking about being able to sort of privately have money and having that access sort of be, let's say, more particularly held on your phone, for example. Some of our clients with my Human Rights Lab have to very slowly partition money out of their shared bank account, right, in very small sums. So this isn't necessarily a total answer to your question, but it's more to say that there is a variety of kinds of specific constraints we are thinking about in terms of how to shape this definition. And that's what I actually think is the strength of our dynamic coalition, is taking all of those constraints and concerns and very different user groups, their needs very, very seriously.
And just to build off of that, in case it sounds a little unusual that we're so focused on the definition of this term, it's because we've realized that there are so many different conflicting definitions of what digital financial inclusion means to different people. And so we think it is important actually to tackle that and to understand why there are these differences and to explore what we think should be based upon the definition that we feel comfortable with, recommendations there. And we're trying to put together some work that we'll be able to share out, as well as literature review, to show you what those different definitions are, because they are, of course, influenced by different stakeholders and different interests altogether, some of whom respond to some aspects of inclusion and some which do not at all. Are there any other questions from the audience?
Thanks. I wanted to pick up on a point that Jeremiah made earlier. Sorry. Yeah. Jeremiah, you talked about people proving they are who they say they are. And I think that's a rather surprising idea, because when I use my banking application, I've already proved to my bank who I am, or I couldn't use it. Why would I need to prove to anybody else in the financial system who I am? Wouldn't they just take my bank's word for it? And then I started to think about the inspiring stories that we heard in the previous panel discussion about setting up things from scratch. And it occurred to me that, of course, poor people already have financial institutions. Otherwise, they couldn't get by. They have the kind of financial institutions that we heard about, where people help each other with savings, with loans, informally, things like that. The problem is that those systems aren't recognized by the rest of the financial world. And maybe a way forward to start with that would be to say there should be clear criteria that would enable a financial institution, however small, to open an account at a central bank, which means becoming part of the financial institution. And once that financial institution is trusted, then it's the fact that it allows its members to transact should be sufficient for the rest of the financial system to take that into account, right? Basically to trust what is said. That's certainly the way, for instance, we operate. I work for the Motor Loop Foundation. We don't want to know what account numbers people have. All we want to know is which institution to ask to pay those people. We're not interested in who they are. We just want to know that there is a financial institution that says, yeah, I recognize Aidan's identifier, whatever it is, might be a phone number, might be a mnemonic, anything. And I will guarantee to you that I will pay him if you send me the money.
Right, so there are two things there. The latter half of having smaller institutions be able to join a central bank and participate as equal members in that, huge fan. Yes, I think that's a fantastic idea. I think the greater diversity we have in the size and scale of financial institutions that are participating in the network, the stronger the overall financial network is. So big +1, I guess, to everything you said there. The first part about digital identity and why do you need to confirm your identity again to make a payment once you've already given that identity to your financial service provider. The primary part about that is for fraud prevention. We've seen that as we make it much easier for money to move, it is also much easier to scam people. And we have like a regulation inside of the EU, which is, in addition, you need to have, you want to make a payment, you need to have something you have that represents who you are with something you know. And if you have all three of those things together, we can have a very high confidence that it's really you who is making that payment and not someone who has stolen your password. Like just relying on passwords is not good enough in this digital era, and not relying on one security mechanism alone is also not good enough anymore. Devices can be stolen. So if someone steals your phone, they shouldn't also steal control of your bank account. There should still need to be some element of something that's in your head and then some other aspect about you to verify yourself. So in the mobile space, these are primarily different biometric features of your mobile device, but there are a number of other tools that can be used there. So that's why. And then the cool thing is, like, once you actually have done those pieces to prove who you are, that's basically saying, okay, I am a legitimate player in this system. You can kind of, ignore the fact that I was the specific person sending the payment, and then the person who's receiving the payment, know about them. They're the ones they're the ones receiving money that you might want to investigate for fraud or crime or tax evasion or something like that.
Thanks. We only have 3 minutes left, so if there are any further questions, I can take one very short 30-second intervention.
Sure, my question is short enough. How would you aim to convince a marginalized group that may have been burned by a large institution in the past to adopt digital payment technology?
I'm sorry, I was having a hard time hearing
Who
that.
wants to tackle that? How, if someone has been burnt in the past by a large financial institution, how do you convince them to try out a new emerging product? Was what I heard, at least.
That's exactly it, yeah.
I can take a shot. I mean, I think the answer is very difficult. If I knew the answer, I would be sitting somewhere in a regulatory capacity. But I think one way would be to strengthen your consumer protection safeguards. So, to build trust by convincing the person that we now have redress mechanisms that if this were to occur again, there is a way to indemnify you, or there is a quick way for you to get, redress and remedy for the situation. So somehow build trust into that ecosystem so that the person is convinced that's not going to happen again.
Thank you.
Perfect. And to wrap up, I would just ask each of our panelists to share a closing thought on, because we again have some parliamentarians in the room, I just want them to hear some suggestions from you as to actions they could take away from this. If we So as a dynamic coalition, we've been exploring some of the barriers to participation and reasons why people feel excluded from financial systems already. They can be infrastructure related, they can be literacy related in multiple senses, in terms of financial literacy, in terms of digital literacy, in terms of literacy around creating your own financial institution, a tier 2 institution perhaps. We've heard economic barriers can be barriers to participation, regulatory constraints. But in terms of really those regulatory constraints that contribute to financial exclusion, what actions would you like to see lawmakers take to address those barriers?
Sure, I think very quickly, and I'm speaking from a very specific space. I just finished up 2 years at the UK Data Protection and Privacy Regulator, the ICO, where I was part of a pan-regulatory group with the Competition Markets Authority looking at what we call harmful design patterns, or what are often called dark patterns. A lot of these harmful design patterns proliferate inside of things like e-commerce, fintech, and also different kinds of privacy manifestations. So if you've ever seen a cookie banner but found it really hard to reject, that's a harmful design pattern. If you've ever unsubscribed from something and found that you were still subscribed, that is a harmful design pattern. We've also seen the FTC going after this in particular with the announcement of last week, the click to cancel, making it as easy to cancel to sign up. Now these might seem like very minor things. Design is the layer of which all users are interacting with your technology. It's also, I think, a prime area for consumer safety in terms of regulation, but also analysis. So I would love to see more harmful design patterns related regulation that's also specifically thinking about banking, but also new emergent spaces like blockchain. And we're already seeing pushes towards that with dark patterns related regulation inside the EU with the Digital Services Act and the Digital Markets Act. But I think that there's so much more to explore there.
I'll give a software answer for this. There are standards bodies that you can join that are expensive to join, and then just to participate in the creation of those standards, and then when you want to read the standards, they're expensive to just get access to those reports, and then it usually results in proprietary software that is also expensive. We have a different opportunity to create something in the open. So there are a number of different organizations that are here today. Interledger is just one of them. We have been building in the open with a variety of participants. Everything that we are creating is free and open source to use because we believe that the thing that should really differentiate financial service providers is a service that they are providing to the communities where they are in. Please support the openness of those standards, not just in the word open, but like make open source a mandate and make those open standards a mandate so that we can solve this problem collectively instead of every country solving it individually. It doesn't make sense to just keep repeating the same pieces of code over and over and over again when that's not really the hardest problem in this space.
Should I? The time's up.
10 seconds.
Super quick. Okay, I'm repeating a point I made this morning, but I think in payments there is this tendency to, move towards being frictionless, and that's deemed to be a virtue. But I think some friction through regulation is often a good thing, especially when you're in uninitiated user groups, and that's the target. And I think just the fundamentals of going back to the basics of consumer protection, accountability, transparency, redress, I think those are the things we need to think about in the context of payments as well.
Well, thank you so much. Thank you to everyone for being here today, for your questions, and a huge thank you to my panelists.
And a big thank you to Aiden.
Thank you, yes.
Yeah, thank you for our moderator.